school. They're no longer good at math. They're no longer interested in math. Like there is so much data on this. And this is actually sad because 90% of women will be managing their family finances one day, right? So even though we are discouraged as a society or as a culture from taking charge of our finances, the sad part is that we're all going to be running our finances likely. And we should be getting lifelong training on this and not some on-the-job training, at the 11th hour, basically, after things happen to us, right? And so that to me is such a sad commentary. And what we see here then is $54 trillion passing to surviving spouses. And again, most of that is women. You see the numbers here. So women, are starting to exert some influence on wealth management, not as much, or we're not seeing as much of the effect yet, because the wealth management industry is basically, 80 to 85% men. And I will tell you, in many respects, I do think they have been slow to respond to this demographic change. And I think that, that speaks for itself, right? And so you see then women having certain needs in general. We are, generally speaking, more financial planning focused, more goal focused, more family and community focused. And there's, again, a lot of data to support that, where the men have a tendency to be a little bit more investment focused, hot tip focused, right? So you can see a little bit. And it's not that women don't want that hot stock tip, and it's not that men don't care about planning. But, again, there is data to support, what I'm saying here. And yet, because the financial advice profession is literally 80% men in charge, there's been a slow adoption and slow respect for some of the needs of women, which, again, is sort of one of the roles that we're playing at Carson Wealth Franklin Lakes. So we see here again more data. Our wealth has grown 80% since 2018, significantly outpacing overall, like more general wealth. And there's a lot of wealth that's been amassed by the baby boomers, again, for spending by the women and then eventual inheritance to the women and then to their children. We talked about 90% of women managing their own finances, and yet less women are investing. And so it's interesting, women are sitting on more cash. They're not investing as aggressively as men are. And I would say, and again, the data shows that the women don't feel as comfortable with the options presented to them or the people in presenting those options. And so if you don't really feel comfortable with the people who are talking to you or how they talk with you, then you have a tendency to say, hey, something, I'm just going to hold on to this. I'm going to just keep this in the bank, right? Because you're not feeling that great fit. You're not really feeling that you're being spoken to. Let's go through the 5 myths of investing. So the first one is money should be kept in liquid assets or stashed away at home. The challenge with this is inflation and a loss of purchasing power. And so even though for now, for today, cash might feel okay, money market CDs, and even though those rates are decent for now, when you factor in inflation, it is a negative rate of return. And certainly for the long term, this is not a viable option for most people. You need your money to grow. Otherwise, you will lose purchasing power and you will buy less in the future than you're able to buy today. And for most people, then that's not acceptable. If you're worth millions and millions of dollars and you live so well within your means that the purchasing power can erode over 10, 20, 30 years, and you're still okay, there are some people that are in that situation, sure. But most of us need our money working for us so that 10 years from now, we can buy the same things as we can buy today. The second myth is men do better at investing. This is interesting because, men have a tendency to be a little bit more confident overall than women, particularly when it comes to investing. But what I have found, and the data supports, is that women make great students. They're very teachable, and they make great investors. And so even though a lot of women don't see themselves as capable, they actually are very capable. And when given that opportunity to manage their wealth, a lot of them really shine. I see very few women doing stupid things with their portfolios. And yet I've seen plenty of men do stupid things with their portfolios. I can just live off my husband's income retirement. Sometimes yes, and sometimes no. And so this is the idea of being a good steward with your family's money. Let's do a plan. Let's map that out, right? Let's be really smart about this. I don't know enough about investing, get started. I've had people start with me, in their 80s, in their 70s, even early 90s. There is still an opportunity. I say it's never too late and it's never too early. I've had people come to me, women, who just suffered through, a life transition, like becoming newly widowed, for example. But also maybe there's an inheritance and you're like, hey, I've never dealt with this. I've never taken an interest, but now I have this inheritance, or now I'm a widow and I need to step in. And again, I find the women to be so capable and so really good at this. And so regardless of your situation, don't be shy. And we're here to support you, right? That's why there's, 9 of us at this office, everybody, and I'm sure you'll agree, super sensitive, super supportive. They've been trained well. Their hearts are in the right places. So let us be your guide. Let us work with you. It's one of the reasons we send a weekly newsletter out, right? It's one of the reasons we even have these webinars. I don't have time to deal with investing. And so, yeah, I mean, we live busy lives, right? So part of our role is to help make it easier for you and help take some of that burden off of you. But I don't ever want you to feel like, oh, I'm too busy for this. This is your support, your survival, your life's enjoyment, and also for your children and possibly even grandchildren. And so we don't want to be too busy. I think maybe whenever you say, oh, I don't have time, I think that maybe is masking another issue, right? Is I don't feel comfortable with this. I don't know where to start. This makes me stressed, right? And so let's figure out what the thing is, and then let's help you solve it. And feel free to send me an email, call me, reach out and be like, hey, Debbie, I'm so glad you're talking about this. Here's the situation for me or for a friend or a loved one. We haven't dealt with this. What do you recommend? How can we move forward? So this is one of the studies that I referred to. And by the way, this deck is built on several studies. Goldman Sachs had a study. Simon Kucher had a study. So there's a fair amount of firms out there, the consulting firms. I mean, this is big, right? We just had a slide back there talking about the great wealth transfer. $54 trillion is passing to surviving spouses. And 95% of that, right, 51 trillion, is going to women. If you think that folks are not paying attention, right? You're wrong, because money speaks. So they are certainly paying attention, and they want to know, why aren't women investing more? Who are they investing with? What type of advisor do they want? What types of investments do they want? I mean, they're asking all these questions. It's just taking them probably a little bit longer to, act on it than we would want, right? But if you look here, over time, you see here that women feel empowered by exposure to financial information, where men want discussion, they want investment ideas. But you see here on the left, women want financial information, self-study, webinars, reliable financial advisor, long-term planning, and robust budgeting, right? So you see there's definitely a different vibe here, based on that study, and that's been repeated in a lot of other places. Let's just see here. So Debra is raising her hand. So if we could wait to the end, because this is being recorded, and I think compliance doesn't want people talking while we're still presenting. So Debra, if you could wait, and then we'll get to your question after we're done recording. All right, 5 tax gotchas. So here are the 5 tax gotchas. And this is my way of saying, hey, the government has ways to catch up with us. And here are the key ways that the government is trying to, basically take our money from us, right? They're called the tricks, the gimmicks. So these are the 5 tax gotchas, and I'm going to go through each one of them. So the first one is these large traditional retirement accounts. It could be your 401k, it could be your IRA. But if you've got, millions of dollars in these retirement accounts, they're going to create RMDs. And those RMDs, required minimum distributions, create a huge tax burden on you when you're married, on you when you're single, and on your children because of the Secure Act. And we're going to talk about that in a second. And so nobody really talks about this, because that large retirement account becomes a burden when it's time for distribution planning. And so nobody's really talking about that part. Everybody's focused on accumulation, like put your money away, do the 401k, create these big balances. And you're like, yes, I will do that. Yes, I will do that. But then the distribution part, how do you draw down these accounts, is a whole other way of thinking. And that large traditional 401k, that large traditional IRA creates a distribution nightmare. It creates a tax nightmare, and that needs to be managed. So ideally, we're addressing that up front and making these contributions to a number of different types of accounts. But if we didn't deal with it up front, maybe you weren't a client then or what have you, then we need to address it as this money comes out. And there are ways to do that, but you want to be proactive with that. Rising taxes. So yes, the OBBA was passed. We did a seminar on the OBBA last month. And if you want to see a recording of that, reach out to us. And so, yes, the tax rates have continued to be low, but, this is subject to a different administration, different people in charge in Washington. And even though tax rates are overall low, then they could go up. And right now, then, we should still be taking advantage of these low rates, whether that's Roth conversion, distribution planning, like whatever we're doing, the rates are low. You see this here on the chart. The rates are, historically low. Let's not be complacent about it. Let's take advantage. The widow's penalty is a nightmare. So if I've got, a traditional couple, a man and a woman, and he passes typically first, then the widow is filing single. Now, look, if it was a guy survivor, if it was a same-sex couple, right, whoever the survivor is, he or she is filing single, but typically it is a woman, right? And that may drive her tax rate up by 10%. Because you've got basically almost all of the money coming in still, because all the money basically gets left to the surviving spouse. Yes, I get that you go from 2 Social Securities to 1. I understand that. But other than that, most of that money goes to their surviving partner. And then she has all that income, but she's filing single. And so that is a really challenging situation. It also drives up her Medicare IRMA surcharges because, believe it or not, there's not a big adjustment for her. And so she's often paying the same amount as when they were a couple, paying the same amount. So if the couple was paying $3,000 a year, she's also paying $3,000 a year because as a single person, she basically has the same income. So that, and there's a number of other ways that the widow's penalty gets you. And again, these are things then we want to plan ahead for. And then the Secure Act makes it expensive to leave that large IRA to your children. And here you see just an example. With some good planning, we could create a several $1 million Roth IRA for the children and drive down the traditional IRA balance, which is what you want to do. Remember, I was saying before, you don't want that traditional IRA when you're in retirement. You want to drive down that balance. Traditional 401k, traditional IRA, you want to drive down that balance because it creates a problem at the back end for you as a couple with RMDs, for you as a surviving partner, and then also for your children. So estate planning, the OBBA basically put as permanent, which in Washington is written with a pencil, permanent, the $15 million lifetime exclusion starting for next year, adjusted for inflation. This year it's $14 million. These are very generous lifetime exclusions. And so if you are near that limit, if this is something that's of concern to you, then let's go after some low-hanging fruit. Let's do some gifting, right? Also remember your states, your inheritance tax and estate tax in a variety of states, right? About 20 states have an inheritance or an estate tax. You need to worry about that. You need to worry about it in New York, right? You need to worry about it in Massachusetts, Minnesota, right? There are a number of states that go after estates. And even in New Jersey has an inheritance tax. And we had a client that had to pay almost $2 million in inheritance taxes because her partner that she'd been with for 20 years left a very large IRA to her. And because they never married, there was close to a $2 million tax on that in New Jersey. So there's some tricky things out there. 5 reasons to expect volatility. So we knew that there would be volatility this year. And, we had the market up for the last 2 years, about 25% each year. So coming into this year with a market that had been up, with a president, a new president, a lot of controversy, we knew this year would be rocky. In April, the market actually dropped 20%. In April, we technically hit a bear market. And of course, we're back up now 30% from that time. So another reminder, right, not to panic, to stay focused, because the market has a tendency now to drop very quickly and to bounce back very quickly. And it drops without warning, although in April it dropped because of the tariff announcement, but it can drop without warning. We've seen that. And then it will bounce back just as quickly. And so more and more we're saying to clients, we can play around on the margins, but we really, for the most part, want to create a great portfolio, want to try to stay the course. And then what we'll do is Rob will bring in some hedging strategies to help us, sort of directionally. So if we feel like the market is a little richly valued, we might start hedging a little bit more. When the market pulls back and it's down 20%, we'll lighten up on the hedges a little bit. So there are some things that we are doing within the portfolios. But this notion of, hey, let's just go to cash, let's sell 80% of it, that tells me that we may not have created the right portfolio for you in the first place, because we really want to create a portfolio that's essentially an all-weather portfolio that you feel comfortable with. And if that might mean creating a separate cash position for you so that when the market goes down, you don't panic, you have a place to go get your cash, right? So there's a lot of ways to approach this. But the idea is, the market's down 20%, let me move to cash. No, we've got to think this through and approach this in a more thoughtful way so that we're not selling at a bottom. So 9 key strategies, right? We want to time our IRAs, retirement plan contributions, right? So when the market goes down, let's make lemonade from our lemons, right? Let's make those contributions. Let's think about Roth conversions. We did those in April for clients. We were ready to go, right? We had analysis ready to do those Roth conversions, and we did them when the market was down. It was brilliant. And then maybe during those tough times, we tighten our cash flow. Maybe we push retirement out another year. Maybe we bring cash in off the sidelines to invest it when the market's down. Maybe we rebalance our portfolios to get a little bit more aggressive. And then we think about our gifting and estate planning strategies. And let's, again, take advantage of that, right? Let's gift it out of our estate, whatever it is, when the asset is depressed. We get it out of our estate at that depressed value, and then let the appreciation happen when it's in, our giftees' hands, right? Whoever you're trying to donate to, the donee, let the appreciation happen in their hands, not in your hands. So, a lot of sort of techniques here that might not seem so obvious, but when the market pulls back, there's a lot of ways that we can profit from it. It's almost like a welcome relief. It's like when there's a rainy day, and then you're sad that it's a rainy day, but it gives you an opportunity to clean out your basement, or to take a nap or watch an old movie. It's the same thing. You don't want a rainy day every day, but every once in a while, it gives you an opportunity to address certain things. Okay. So here's some solutions in the volatile market that we just talked about. Remember that capital gets redistributed. Okay. It doesn't go away. It just moves around. And so we need to figure out the way to make money, because there's always a way to make money. And most of all, don't panic. All right, let's increase wealth. Some of these things that we've talked about already. So let's use taxable, tax deferred, and tax-free accounts to create tax diversification to drive down taxes. Let's leverage these Roth IRAs, again, to lower those RMDs, to create a more tax-efficient portfolio for our surviving partner, for our loved ones, for our heirs and beneficiaries, right? Lots of reasons that we want to be tax efficient. And remember, when you're not tax efficient, when you create tax drag, that could last for decades in retirement, right? You're retiring at 60 or so, whatever, and you're living into your 80s or 90s. So we can't afford to be tax inefficient with these portfolios. Ideally, you invest in the portfolio when the market is down, and also when you think your future tax rate is going to be higher, right? That is the best time or the best way to think about doing these Roth conversions. Here's another visualization of this, is again at these lower tax buckets. We harvest income, we accelerate income, we do Roth conversions. But let me be honest with you, we can also do it at these higher tax buckets. There are times that this makes sense to do it around here. When does it make sense? Well, let's say the market's gone down, but you're in that highest tax bracket. Well, maybe we do that Roth conversion because the market's down 20%. And then when it bounces back, you've made all that money, right? And now you sort of didn't really do it at the 37% tax rate, the Roth conversion. You did it in equivalent of a 32 or 33% tax rate because the market was down 20%. So I've run these numbers, and this is where it can make sense. Also, you might be in a high tax bracket, but you may be concerned that you're going into even a higher tax bracket. Maybe you're moving to a high tax state. Maybe this year you're making a certain amount of money, but next year you're going to make even more, right? So there are reasons where even in the highest tax brackets, or you want to prepay the taxes for your children, right, who are also in high tax brackets. And you're saying, hey, let me get this out of my estate. Let me do a Roth conversion. My kids are in high tax brackets. I'm in a high tax bracket. So let me take the hit now on this and do a Roth conversion. So there are subtler ways to think about it. It's not sort of the obvious approach, but it can make a lot of sense. Maximize the valley, the income valley. So again, between retirement and RMDs or Social Security, or other times in your life where your income might be dipping a little bit, that's a great time to do some of this tax planning. Again, when you're in a lower rate, your income's low. Asset location is critical. Make sure that your high growth stocks are in your Roth IRA. Make sure that your income producing, like your bonds or your REITs, make sure that those are in your traditional IRA, because they kick off ordinary income. You get taxed a lot on those. So asset location actually can be very powerful. Tax loss trading, capital gain harvesting. So again, markets down, let's do our tax loss trading. Let's think about capital gain harvesting, right? Again, a lot of these things people don't even think about, but we have a whole checklist of all the things that we're constantly going through for you. Let's review our benefit plans. Remember, there's Roth 401ks, after-tax contributions, daily conversions of the after-tax accounts. These are all in your employer retirement plans, but there's a lot of opportunities here. So we'd be happy to review your benefit plan. It's electronic. You send it to us, because there are so many tax advantage benefits, and a lot of times people are not aware of them. This is talking about the Roth 401k. And then the other thing here is these catch-up. See here in 2025, they're allowing you to do an extra $4,250 when your age is 60 to 63. So those of you who are still working, who are age 60 to 63, let's take advantage of that extra catch-up contribution. Backdoor Roth conversions, another, again, slightly less obvious approach. Again, trying to build that Roth account. Health savings accounts, the triple tax-free benefits. We love HSAs. You can't contribute to an HSA once you're on Medicare. So for many of you, that doesn't make sense. But if you have access to it, it's really cool. It's like a Roth IRA for medical expenses. Annuities and life insurance. I have to mention this. For some people, it can be helpful. It's not typically our first choice for people, but there are times where the annuity or life insurance can make sense. Like if you're trying to replicate a pension or a certain type of payout, then the annuity or the pension annuity or life insurance can make sense. Charitable giving strategies, right? Those QCDs up to $108,000, donor advised funds, charitable gift annuities. Again, so many of this, it's so deep, the bench, right? Like all the creativities, which is, by the way, why I love it, right? Because there's just so many things to do if you know what all those options are. And then estate planning, legacy planning. Again, you have $14 million to give away, each of you, $15 million next year. So federal estate taxes are generally not a concern for a lot of people these days, but still we have clients that are going to have a federal estate tax issue, and we need to address that with them. But certainly we should be concerned about the states. If you're in a state that has the estate taxes or inheritance taxes, or if you're relocating, and also some of these strategies. And also remember that your estate is going to grow. So again, if we have a fair amount of money, and we're going to gift some anyway, let's do some of that gifting now, right? Let's go after that low-hanging fruit so we don't have to worry so much. So here's a listing of the 10 key strategies. Just a summary list. And now then, let's review. So what do women need? Here's our view of what women need. Women need education on financial topics, on wealth, and that's very broad, okay? Like women want and need, and we all want and need education, right? Like I'm a lifelong learner. I am reading all the time. I read everything I get my hands on. And I'm not necessarily saying you should be doing it that much, particularly about wealth management, because that's why you have us. But, I do think people feel more comfortable when they have some visibility on these things. Women like community with other women. So we're having those, events at my home, and the women come, they're supportive of each other. They've created friendships outside of us together. So for example, we had two women in today, and they went to lunch with one of the other women from these events at my home. So there are these lovely friendships, support, fellowship that's being created, and I'm just so happy that we can be a part of that. Women want sound investment strategies. Sure, they do. Of course they do, right? Women want their money to grow. And women want advanced financial and tax planning to address their unique needs. Women generally see beyond just the pure investment. And I'm all about making money. So don't get me wrong. I'm all about, let's try to get the best opportunities in your portfolio. But then it's like, what are we going to do with this, right? How do I help myself? How do I help my children, my partner, my community, right? Like, where do I go with this? Because money is a tool to an end. And there are people or causes that you care about. How can we help you with those people and causes? And I do think that women have a tendency to focus a lot on that, where the men maybe not as much. And that's the most fun, is helping you with all these planning opportunities. Here is the ultimate goal for us, is climbing to the top of this value ladder. And so if you look at the bottom of this, right, this is like the basic stuff to me. This is like the table stakes, like, oh, pick me a money manager. Sure. Asset allocation, some base debt, cash flow, right? Like, this stuff's important. Don't get me wrong. It's managing the money. And there was a time where this is basically, all that was done for a client. And then we said, oh, we can help you pursue goals. And this is the financial planning part of it, right? Like, oh, I want some retirement planning. Okay, great. I want to put my kids through college. Okay, great. Like, we can help you with all of that. But really, where we want to be, and I think we are for many of you, is up here at this highest value, is we want to help you take care of loved ones. We want to give you more organization and control, more time. We want to cut down your worry. And we want to help you with your purpose and leaving a legacy. And so we think all of this is important. I mean, you definitely need the foundation. You definitely need the things down here. Don't get me wrong. But this is where we're really flying together, and we've really accomplished something, truly special. And so this is where we try to be with you. And that's really what the team all together, collectively works towards. And so with that, then, this is our contact information. You all know how to find us. And, financial independence is about having more choices, right? But I would tell you, it's honestly helping you to live a life of fulfillment, a life with more peace, where you can worry less, right? But more peace and just really living your best life, a truly fulfilling life, whatever that looks like, right? That's what we want to help you with. And so with that, then, I think we can, well, Jessica, if you could mention the upcoming events very quickly, and then we can stop the recording and just take a few questions very quickly. So Jessica, why don't you come on and do the closing, the outro, and then we can go off recording and take some questions.
Absolutely. Well, first of all, thank you again for joining us, and sorry about our technical difficulties earlier there. So thanks for your patience. So thanks again for joining us today. And thank you so much, Debbie, for doing such a great session. And mark your calendars. We have a few upcoming events. Monday, the 15th of September and the 16th of September, we're doing our annual client advisory board. Monday is virtual, and the in-person one is on Tuesday. So we hope to see a lot of you there. And then on Saturday, we're going to do our second annual Pumpkin Festival event at Heaven Hill Farm. So mark your calendars. We're excited to see everyone. So thanks again.
Wait, what date is that?
Saturday, the 20th of September.
Okay, yep. So that's a busy week, right? We have the client advisory board, which we encourage participation. And I think we do a little DoorDash gift card, right? Or if you come to the office, we feed you lunch. And you get to see all of our smiling faces. And so we have two options, virtual or in person. and that came out of COVID, obviously. And then that Saturday, what date was that? The 20th?
Saturday the 20th. Yeah, Saturday
Yeah.
the 20th. And we're going to be releasing information in the coming week about all of these events in September. So stay tuned.
And that was a huge hit. We had over 50 people last year, and it was the first time we did it. The place is like Disney World on a farm, Heaven Hill Farm. It's amazing. And it was just great. It was just great. We were the there getting all the pumpkins. The first week they were there. There were children, grandchildren, families. It was a lot of fun. So anyway, please join us. Okay, with that, then we can stop the recording.
Okay.
And I saw that Debra had a question.